Hey traders, Steven Kowitzel here. It's Thursday, April the 12th in the afternoon hours of trading. Before we get into the market, let's take a look at the disclosures real quick. Okay, made the lawyers happy. All right, so let's go back to this page right here, kind of hit the refresh button real quick. In a choppy market, as I always say, you want to pay attention to where the market finishes, not where it starts. Now, not every day is the perfect day where you get, a nice upward trend at the beginning of the day and it holds throughout the day. Sometimes you get some sell-off, but what you really want to pay attention for is if the market starts really strong and then just rolls over in the final couple hours of the day, kind of like we had yesterday. It's just worth noting and worth paying attention to. So if we look at, let's start with the S&P 500 on the daily chart. So you look right here and you had, a nice uptrend, nasty waterfall. We're really at this double bottom right here. Now this, the leg of this is really choppy, really sloppy. Most bottoms are not as clean cut as this. They're going to chop around for a little bit. But let's look at the positives first. Positive number one that I see is we have a support at around the long-term moving average, around that 2580 area, which the S&P 500 really hasn't closed below. So you got support at 2580, okay? You have a double bottom put in place. You have a shakeout that has already occurred. Everyone that was getting sucked in probably started to get stopped out right around here to take another leg down. So I always like it when there is a shakeout because it typically means there's going to be a better uptrend on the next leg up. And then you had a follow-through day in the market, which according to IBD is a minimum of fourth day off the bottom. And volume above the prior day, a minimum of 1.25% up. Now that's IBD's definition of a follow-through day. What concerns me, so those are all the positive things, okay? What still concerns me a little bit is you have a lot of distribution right here. And on this bounce right here, not a lot of accumulation, okay? So again, when this climbs the right side of the base, you want to see more accumulation followed by breadth pushing it up. But you had a breakout day, and then now you have the NASDAQ and the S&P 500 punching through that 20-day moving average, which is key in a nice rising trend. You want to see that moving average holding for the most part, that 20-day moving average. Now we're above it. Now we're going to find out if we can hold it or not. But, even if we go back to the 2015 correction, it looked very similar. You had a double bottom, you had some chop in the middle, double bottom, and then the leg up in February, or the bottom in February of 2016 produced an amazing uptrend. So you definitely should have put some money to work. As the outside day, I know we did, the members did, as an outside day right here. So a potential reversal being put in. You had a breakout day, and we're going to continue to see if the NASDAQ and the S&P 500 can hold the 20-day moving average. I think it's very important that you don't have too negative of a stance and wait until the market's all the way up here. Then that's typically gonna, just shake you out, right? So when you get that reversal day, you put a little bit of money to work. When you get the breakout day, you put a little bit of more money to work, and then you slowly get in. That way, if the market doesn't go up too high and rolls over, you probably at least made a little bit of money on your first and second position, and maybe your third position, you got stopped out, okay? So rules-based investing, make sure you have the rules to get you in. If you don't have rules to get you in, you need to get some. That way you don't have too negative of a view, because it's really hard to be too positive when you got all this chop in the market. So don't let your emotions get the best of you. Slowly get in and slowly get out. Now, not all uptrends work, as we know that. Some of them don't go very far. And guys, that's a part of trading. Don't worry too much about the noise, because it just so happens probably the time you decide to take a pass is when you're going to get an amazing best trend in 3 to 5 years type of trend, and you're going to be sitting there, chasing it all the way up. So have rules to slowly get you in and rules to slowly get you out. Let's look at the 60-minute chart. So on the S&P 500, again, I don't really pay attention too much to this short term, but you have closing support at the 2560. You have this gap right here around 2700. Seems to be a pretty important area where there's been support and resistance. So I'm interested to see, if it comes up here, it might pull back a little bit and punch through. I don't know. But, I tend to be in the camp of I'm going to, because my rules are sucking me in the market, I'm going to be cautiously optimistic until it doesn't work, okay? So I tend to thinking that we're going to get an uptrend just because we've already had a second leg down, we've had a shakeout, the market's breaking out, so don't be too negative. So let's look at the NASDAQ. So I really just kind of want to review the rules base, when to get in, when to get out. So you have the market that reversed right here. So you have a nasty leg down, and then you have a reversal. So I'm buying a little bit on this day. Not a lot, maybe 10 to 20% of my account, but I'm buying a little bit on this day because probably a conservative position, maybe an ETF, maybe a broad, maybe an aggressive ETF, but just an ETF, because an ETF isn't going to get whipsawed around as much as an individual stock might if it comes and takes another leg down. So putting a little bit of money to work, maybe you do it on the next day, then you have a market breakout or a follow-through day according to IBD, then you put some more money to work, okay? So the rule slowly lets you get in, and then I have a trading system that's in my members area, and for the members that are watching, it's the ETF trading system. So what I did, and I've studied these follow-through days, market breakouts that go back to January 2007. And what I realized is a lot of, if the market is, so after the breakout, then you slowly get in, right? So you're buying on this day. And if in 4 days after this purchase, if the NASDAQ is higher, 4 days, then you put more money to work. So after that 4th day, post-breakout day, if the market is still higher, you just increase your odds of this trend working. So then you put more money to work 4 days later. And then what you're doing is you're riding the 20-day moving average a little bit to follow that trend, okay? And when the 20-day moving average breaks, at least the short-term trend is over. It might need to correct a little bit. And you can see it doesn't always find support at the 20-day moving average. Sometimes it's the 50-day. But if you're looking for more of a shorter-term trend, again, 4 days after this day right here, I think the odds of the uptrend resuming has increased. So you got to continue to put money to work, make it rules-based, whatever you need to do. And if you're not sure of what to buy, you can just buy an ETF, keep it simple. It doesn't have to be complicated. And I know that after this kind of a second shakeout, some people are shaking in their boots, and trust me, I was too. But again, a little bit here, a little bit here, a little bit here. Slowly see how long that trend can last. You're just following the trend. That's all you're doing. Some trends are very short. Sometimes there is no trend. There's one thing I can guarantee: the market's going to go up, down, or sideways. So just whatever it's doing, just be aware and follow that trend. Or if the market's going down, stay in cash until a better trend resumes. So commodities have been really interesting lately. And I want to take a look at that. Let's take a look at the CRB too. Okay. So commodities are firming up right here. Okay. So you have the CRB index, right? Commodities are firming up while the dollar is looking like it wants to break and take another leg down. So just when I thought, the dollar was going to have at the minimum a counter trend rally, it could chop sideways, could go up, could go down, but with the CRB and oil looking kind of strong, it's something that I'm watching. It's just so close to in this zone. And we're going to look at the dollar on a different chart here in a second, but it's so close to just cracking a little bit further. The dollar is in a bear market, so you have to expect bearish outcomes, but when it's so oversold, sometimes you just get these counter trend rallies, and then it comes down to an 11-year trend line, or excuse me, an 8-year trend line, and then you think you're going to get a counter trend rally, but always follow the price. The price will tell you everything, because it didn't break out, and now it's starting to crack. So we'll keep an eye on this, but it could be very interesting to watch to see what the dollar does and how that correlates with the CRB. And you can see the CRB is up, 3.5% this week. It's firming up right at the long-term moving average. Now, this doesn't really find support at long-term moving averages because this is a collection of commodities, each with their own support and resistance. But it seems to be riding this trend line right here. So I'm very interested to continue to watch the CRB to see if it decides that it wants to head higher. Okay, so let's look at the dollar in a little bit greater detail. See, I'm going to come down here and we're just going to look at the dollar. Okay, so you got the USD. Now this is the weekly chart. So you have a downtrend right here, and then you have a little downtrend right here. So thinking that this was going to break out, and it just hasn't yet. It's starting to roll a little bit, and maybe it just goes sideways for a while. Maybe it puts in a real bottoming pattern where it's just like a bottom rectangle pattern. But you want to pay attention, because if it starts to break 89, it could completely take another leg lower, which, would help commodities and help international stocks. So I want to look at these three relationships right here that typically follow the dollar. You still start with small caps. You have small caps that typically, the leadership typically follows the dollar. Now, all of these are relative ratios versus the S&P 500. So this line is going down. It means that the small caps are underperforming the market, the S&P 500. And when we just got a breakout, meaning small caps are now starting to outperform. It's in an uptrend. So what that means is typically when the dollar wants to bounce, small caps are going to lead the way. Now you have the S&P 500 relative ratio versus international stocks. So you can see that S&P has when the line is going down, it means the S&P is underperforming international stocks on a relative basis. So the ticker VEU is the All World ETF X the US. So you can see that S&P 500 has been underperforming. Look at how all of these topped at the same time. You have the dollar that topped, you have this ratio, and this ratio all topped within the same time frame. So then you have international stocks have outperformed the S&P 500 really since the end of 2016 when everything topped. And you can see right here that large caps, the S&P 500, tried to break out relative to international stocks, and the breakout failed and continues its downtrend. So we're getting mixed signals here. If small caps leadership follows the dollar, these really should move in line. Doesn't mean they do every week, but this breakout failed, and it could take another stab at it, but we'll just wait and see. But small caps are leading the way. Now international stocks continue to outperform the U.S. stocks. And then if we have the S&P 500 versus emerging markets, same time frame. Look, all topped at the same time. So you can see that S&P 500 has been underperforming emerging markets since the end of 2016. So if the dollar, since the dollar peaked, so if the dollar gets stronger, it typically means, typically bodes well for S&P 500 and U.S. based stocks versus international stocks. So, these trends can last a long time when you have emerging markets outperforming U.S. or when you can have international stocks outperforming U.S. or vice versa, S&P 500 outperforming small caps and international stocks. So, again, this is not something, obviously this has been going on. The bottom got put in with the dollar in mid-January. It has been playing out for 3 months now. So you never know how long, these ranges can take, but we're just going to continue to follow it and let the price action and the charts guide you as far as relative strength or what the dollar seems to be moving. So if we look at, let's look at the S&P CRB. Okay, so this is an S&P 500 chart, a relative ratio chart versus the commodity index. It goes all the way back to 1990, and I just want to show you how long these relationships can last. You have the S&P 500 outperformed. Now, when the line is going up, it means that S&P 500 is outperforming commodities, okay? Doesn't mean by a lot, but obviously it was a lot right here. So you have the S&P 500 that outperformed commodities for a decade, really until mid-99 when they started to switch. All right, so during this decade, the S&P 500 returned 266% versus the CRB negative 19%. This is why sometimes it's really, sometimes commodities, I'm not so sure that they are a good buy and hold because they can go dormant for a decade or two until you really get an inflationary environment. So you want to pay attention to the relative stocks because this is dragging down your portfolio. So then you have from, let's just say 2000 to 2011, another decade or 11 years, where the CRB outperformed the S&P 500, and I messed up right here, but 69% in the S&P 5 in the CRB versus negative 8%. In an 11-year time frame, negative 8% for the S&P 500 and CRB, 69%. Okay. Now, from the end of 2011 to present, you can see the S&P 500 is large and in charging. You have the S&P 500 has returned 110% since November 11th, 2011, versus the CRB negative 38%. So it's just really interesting to see how these can just flip-flop, and you definitely want to be in the stronger run because these relationships of outperformance can last a decade or longer. But, you know, the S&P 500 is... I've really been waiting on this relationship to turn because I believe we're towards the end of the business cycle. Typically more inflationary, typically means the CRB should do well. But, you know, it's why you follow the price chart. But here's something that's now kind of interesting. When I look at all these pullbacks in this relationship, you can see they all pulled back and then resumed. Pull back, resume, all the way up. Now you have a slight pullback or resume, and then this just undercut at this 13.5. It undercut this previous pullback. What does that mean? I have no idea right now. But I'm just saying, I don't know if it's probably too early to just say it's a trend change because this isn't really much of a trend change. Could just be a retracement, but something different has happened here. And it's just something worth noting and worth paying attention to, that the relative ratio of the S&P 500 and the CRB has undercut the previous dip. So we'll just really have to keep our eye on it to see if the S&P 500 continues to outperform or vice versa. But, you know, again, this dip right here, this was mid-2016. These tops and bottoms can take a year or two to complete before something major changes. So don't go running and selling stocks and thinking you need to buy commodities. Just follow the simple ratio. Just follow the relative chart. Draw trend lines to follow it. And you can see right here, if you just continue to go down, this is S&P versus emerging markets. During this time frame, S&P 500 smoked emerging markets. And then when you had this top, about the same time, S&P 500 underperformed emerging markets from 2000 to 2011, and then S&P 500 outperformed emerging markets, even though it's starting to switch right here. A lot of times emerging markets can follow commodities because a lot of them are commodity-based countries. However, in the most recent years, a lot of these emerging markets, China, Southeast Asia, they have a lot of technology coming out of them. So a lot of it doesn't have to be commodities that are powering emerging markets higher. They can be just technology and tech companies. And then you can follow the gold, right? This is just a chart of the gold and the dollar, which we're going to get more into this in a little bit. But it's just interesting. I always like to look at history a little bit just to see what is possible. Obviously, there is no sure thing. There is no guarantee. But what I do know is when these relationships turn, one can be out of favor for a significant period of time while the other is in favor. So just keep that in mind. And I think relative charts should always have a position or at some time in your plan. Let's go look at gold. Actually, let me kind of go down to this list. I'm going to switch chart list right here. Let me find, because this is probably more of a commodity webinar than anything. Okay, so you have just the gold contracts. You can see right here, gold did really, really well from, you know, when commodities were outperforming, right? From to 2000 to 2011, and then S&P 500 took charge. So it's just interesting how all these relationships follow each other. But here's the interesting thing about gold. So it peaked in 2011, which makes sense based on the charts we just looked at. This is just the price of gold, broke out of this downtrend, but has this horizontal support resistance, and is now looking like it's breaking through. So you got 1360. This pivot is 1357, so it's rising above that. So you know, gold is doing really just fine from the end of 2015. It's probably up 20+%. Now the stocks have been up more, but you know, this is an interesting point for gold as far as it could be breaking out of this box right here, this bottoming pattern, and maybe we could see a long-term advance in gold. Doesn't mean it's going to be this steep where it goes from 250 to you know, 1826. That's a seven and a half fold. But you know, it's at that point. It's at that pivot point where it's worth paying attention to. So if you look at gold, you got to look at gold miners. Now this is GDX, the purple line. I took the candles, I took the moving averages because it's just trendless, right? It's just been in one big box between 25 and 21, 25, 21, 21, 25. It's just been in a box, so the candles and the moving averages are pointless. But you know, when you start to see GLD is doing just fine, has been in an uptrend, okay? When you start to see, I want to see miners move higher because they are the ones with earnings and sales. The metal doesn't have that. So I always go to this, something I learned from Greg from Stock Charts, the commodities personality. Look at the relative ratio of the GDX versus GLD. Gold. And this is same for a lot of commodities. You want the commodity, the stocks, the commodity stocks to outperform the commodity that they represent. Signals a nice uptrend. So you have this long downtrend where really gold stocks have been underperforming the price of GLD since the beginning of, or February of 2017. So over a year, miners have underperformed the metal. So then you're getting very close to a couple of interesting pivots. Now again, this is a relative ratio chart. This just means that if gold goes up, miners are going up less. Means they can both go up, but it just means one's outperforming the other. So you have this downtrend in gold miners, means the miners are underperforming, and now we're at this spot right here where it could break in the coming weeks. It could break out of a relative ratio chart. If it does break above this 0.18, I would say that is a clear signal for miners, at least assuming that the metal is moving up. That you might want to consider a trade to get on board. But, you know, looking at what energy has done, and we're going to look at that here in a second, it's all looking very interesting. Now, the dollar could reverse tomorrow and shove all these down. So, you know, don't ever fall asleep at the wheel. Don't ever, in my opinion, buy and hold a metal. But it's just, you got gold that's kind of breaking out the price of the contract. Then you got this that is getting close. So, But this bottoming pattern has been in place all year. So we're just going to wait and see. You can see this trend line. I would say this was a failed breakout. I think it shook me out once. And now we're just really waiting on this. So you have the CRB that's firming up. You have gold. Gold is looking all right. Miners are trying to play catch up that could look interesting. And the dollar, we'll kind of wait and see what that happens if that decides to take another leg down. So with that being said, let's just go look at some more commodity related ETFs. So this is XME, right? And this is the XME relative ratio to the S&P 500. And you can see it's been in an uptrend for the most part if you have a longer term view, but it kind of in the shorter term is in a downtrend, because you can see right here, this is nasty right here, 40 to 33. I mean, that's 20%. And then it undercut that. So I would say the XME is in a downtrend until it really it looks like it's trying to firm up right here, and you can see some accumulation stepping in. But you could draw a trend line right across here, probably around 35, 50, 35, 75, and if it breaks through, maybe you could say that the downtrend is over. This sucker can move, and it can move quickly. But right now, I'd still say it's in a downtrend, but I would say that it could be getting close to a breakout, just like the gold miners relative to the price of the metal. So all interesting developments in the world of commodities. Now, what's been even more interesting, I think, this week is what energy has done. So let's go take a look at that. Oh, actually, I can just go one chart over. Okay. West Texas Intermediate Crude, that's breaking out. I mean, breakout right here, breakout horizontal support, 66.82. It's good. I mean, it is in an uptrend. It has been in an uptrend. It consolidated. It needed to take a breather. It's up. So the trend is up. You ride the trend until it's over. And it looks like it is resuming its advance. Have no idea how far this can go. Don't really pay attention to OPEC or don't care. Just follow the trend. Follow the price. That's just the simplest way to do it. There's so much fundamentals and, noise out there. But the price is telling you that it's headed higher. So it could head higher, then roll over. It could head higher to, 150. I don't know. But the price is headed higher, at least as of right now. So we look at XES. XES is the oil and gas equipment ETF. Chart is really interesting to me. It is in a death cross, but it could curl up. Really trendless. However, it did break out right above this 1580, 1570 area right here. So what's interesting is that it had a nice uptrend and rolled over with the rest of the market, but it rolled over a lot more than the market, okay? The market bounced up here and oil did not, or at least the oil stocks did not. So what it made me think was this is the weakest sector. Like, it's not bouncing. When the market pulls back to take its second leg, which it did, this thing is going to crater. Except for it didn't. It really held tight I wouldn't call this tight, but it held in a range for the most part while the market was pulling back. So then all of a sudden, you have this move right here, which is no big deal. It's still looking ugly. And then you have a day where this ETF was up 7%, followed up by 3%, breaking out here. So, okay, now it's getting interesting. Then you look at the price of oil. You're like, okay, oil is breaking out. This thing wants to head higher. I would say that this breakout is valid. This breakout is valid. So, you have to assume it's heading higher. Now, 13 to 16, it's already made a pretty good move. So maybe it retraces for a second. But, this is looking bullish right here to me as it's breaking above this shoulder while oil is breaking out. Then I come down here and do a relative ratio chart versus XES versus West Texas. Well, looky here. You have this downtrend right here, and then the relative ratio. It broke out of this downtrend, meaning oil stocks break out relative to prices of oil. So you got oil moving to a 52-week high. You have these oil stocks that are probably trying to play catch up a little bit. And then the relative ratio breakout, the price action breakout right here. And then you have, the 52-week high of West Texas. I mean, there's just enough signals here to say that the trend is moving up. And I'm not saying it's going to go straight up, but it's, you know, you have to look at the evidence, and the evidence to me is saying you probably want to own an oil stock or two to at least test this trend, because these trends can move. They'll be gone without you, and these commodity trends can be incredibly, incredibly strong. Oh, no. All right, let me change. So let me go back to... Let's continue to look at more. Okay, so then you have the XLE, which is another oil and gas, another energy ETF, right? So it broke out, right, just like the XES. It broke out. It's got a little follow through. Probably come back and retrace and test this. So maybe it doesn't. I don't know. But the breakout is happening. What's interesting also, though, is you have some breadths, some of the high-low percent index breadth, trying to get a little thrust here. And of the percentage of energy stocks above their 200-day moving average, now you have something above 60%. So, you know, like I said, there could be something here in energy. I'm seeing more evidence, more positive things for the energy sector, which, you know, got taken out to the woodshed and didn't bounce. But again, now you have signals that's saying, hey, you know, this could move. And again, maybe it retraces down here and there's your entry. But energy is looking really, really interesting right now. So the market's kind of chopping right here a little bit. That's okay, just as long as it doesn't end up back down here. Again, once it gets a few days out and the NASDAQ is still holding, then I'll be looking to see how long it can ride the 20-day moving average. We don't know. We could have two really good months before we head into summer, after two really bad months. So, you know, the market doesn't go straight up. It has to correct. It has to take breathers. Let's go look at the sector summary. Let's start in the last 1 month. Energy, 4%, XLE, okay? More evidence. Utilities is pretty much breaking even, which doesn't surprise me, but it's lagging today. Technology and financials have been down, so they've been the leaders, and now they're down. They still have strong scooter rankings. Cyclical still have a strong scooter ranking, but energy is starting to get stronger. So that's on the 1 month. Now let's look at the 1 week. So technology's coming back. That's good. That's a bullish development. Utilities are getting sold off. That's good. That's a bullish development because that's a bearish, typically a bearish sector. Energy is back up towards the top. It looks like most of the gains have came in this week, so it's starting to move. Now it's time to investigate. So let me click on this. In the last 1 week, the oil, equipment, and services, see pipelines. So these are the industries. The energy is the sector. So the sector is broken down into industries, and then you want to invest in the strong sectors, the strong stocks, and the strong sectors, and the strongest industry. Tongue tie that. But you have pipelines, MLPs, which hasn't been a lot of money flowing into these relative to the oil and gas equipment. And renewals, you know, solar, stuff like that. Again, the XES would track this right here. So let's click on this. So in the last 1 week, you have a lot of stocks right here. I mean, that's broad participation. 2, 3, 4 stocks down. That's an MLP, I know. Out of all of these, there's money piling in. Maybe you rank by scooter to get the strongest, and you don't want to, you know, pick penny stocks really unless you're looking for a thrill ride. But a lot of strength, right? You focus on scooters above 80, which is a 12-month technical ranking by stock charts. So, you know, I just continue to think energy is an interesting area. Maybe you wait for the retracement, but I think it's time to really look at some oil stocks to focus on that. Now, let's go back. Let me change the list here. So I think you can see my point. The dollar is looking vulnerable. I'm not going to say it's broken until it breaks, but the dollar is looking vulnerable. But I'll tell you what is not, what's looking, energy, commodities, they're looking kind of bullish. They're could be very early of the trend, but we'll just wait and see. So looking at commodities, looking at emerging markets, let's just look at a couple emerging market countries just to check them out a little bit. So you have the BRIC countries, right? Brazil, Russia, India, China. This is the Bombay Exchange right here. I think that India over time can outperform due to their estimated GDP growth. They have a young population, need a lot of infrastructure investments. But so the Bombay Exchange has underperformed the S&P 500 in this pain right here since, looks like it topped in October of 2010. Look at what it's trying to do. It's trying to break out of a 7 to 8 year downtrend line. That could be significant because look at this. Look at how much the Bombay Exchange outperformed the S&P 500. Let's just say from 2000 to 2008. Smoked the S&P 500. I can just tell just based on the ascent of this relative chart. I'm not saying that's going to happen again. You never know. The trend could last years. It could last weeks or months. I don't know. But you follow it until it proves you otherwise, and right now we're at a point. So SMIN is India small cap ETF versus the S&P 500. You can see that it broke out relative right here back a year ago. Okay, so back in early 2017. It's been a choppy ride. It is a choppy ETF. It's aggressive ETF, but is outperforming the S&P 500. You have the India that is on the verge of a very, very 7 to 8 year downtrend line relative ratio breakout. Something that looking kind of interesting. So then I'm just going to grab a pretty liquid China ETF, and that's FXI, the China large cap. I think it's the 25 or 50 large cap. But anyways, you have relative ratio of FXI relative to the S&P 500. You can see right here that it has been rising relative to the S&P 500 since the end of 2016. And you got this little horizontal breakout right here. So the trend is up, right? And now it's continuing to confirm it, trying to confirm its outperformance by breaking out of this horizontal chart that goes all the way back to 2015. So if it breaks out, China looks stronger. So you have this ETF right here that went from 25 to 50 before it got pulled back pretty good. But look, it held support just like the S&P 500 did. The chart looks ugly, but they all do coming out of a correction. And you got to be willing to step up and swing the bat if you're going to hit home runs. So I'm not telling you to go out and buy China. All I'm saying is that, this is could be a fast moving ETF if you hold it for a couple years. I mean, it obviously doubled right here. It's pulling back. It's still outperforming the S&P 500. Not every week or not every month, but the long-term trend, I think, is up. And we'll just kind of see what this relative ratio chart does. So really you have China and India that are pretty much confirming their breakout or on the verge of confirming a pretty interesting long-term breakout relative to the S&P 500. Let's go look at Brazil. So now this definitely is a wild one. This went from 16 to 47, a threefold move. But look, since the same time period, for the most part, you can see that Brazil has outperformed the S&P 500. The EWZ is what I'm looking at. I'm looking at the ETF, not the actual index. Has outperformed and pulling back to the long-term moving average, just like the S&P 500 is. So, I mean, we'll just kind of see what it does. But, Brazil, Russia, or excuse me, we're going to look at Russia in a second. Russia is the one out of the four that is not outperforming. I don't know why it does that. I have good internet connection. So this is just kind of interesting. So Russia just completely gapped down, okay? So think of the BRIC countries as the sector, and then you have the individual industries like we just looked at oil that break it down, right? You want to focus on the strongest industries and the strong sectors. You want to focus on the strongest emerging markets and emerging markets. Don't focus on this one. Yes, maybe it bounces back. Maybe it fills this gap. I don't know. But I mean, something that gap down, I mean, it's not easy for a whole country to gap down this much. So whatever the reason is, that's just a stock that's easy to do. A country is not. So I'm going to stay away from that. So I hope this was helpful. I mean, at the end of the day, I think relative ratio charts are really important to look at long-term trends and just to really give you a confirmation and give you an idea of maybe where some long-term money should be. It's very important, kind of recap, it's very important to look at the energy sector right now because I think it's showing enough evidence that we could get a nice trend. And as far as the U.S. stock market has been incredibly choppy, incredibly volatile, but you have to have a plan to slowly get you back in, and you can't always be worried about striking out because it's going to happen, right? You have to step up and swing the bat to be willing to hit home runs. So create a rules-based plan to slowly get in, slowly get out. If you get stopped out, so be it. It happens to everybody. But again, you have to step up and slowly get in to make any money. So let me know if you have any questions. I hope this was helpful, and we'll talk soon.